excited because I certainly am. You know, congratulations first off on making it through Module 1. Via Facebook, some of the questions that we've got through email, it seems like you guys are feeling that and kind of getting comfortable with that concept. But, you know, one thing I do want to make mention of, this is not a race. So if you need to go back through Module 1, go back through the overview and the homework assignments, by all means, feel free. You know, keep watching that until you understand and master it, okay? And if you don't, please let us know. Remember, quick to implement, quick to ask for help. So if you're thinking, Ron, I don't understand exactly why we're selling a certain probability, you know, hey, shoot us an email, post it up on Facebook. You know, we really do want to help you. All right. So on that, let's go ahead and kick off our Options Paycheck Module 2. Today is all going to be about getting paid, and this is System Part 1. Today it's about getting paid whether the market is rising or falling. You know, back when I first learned how to trade, I was taught that in order to be a successful trader, you had to have systems, trading techniques, trading strategies in place to handle any type of market. Now, back when I first learned how to trade back in '97, any market meant bullish or bearish. There was no, here's how you make money in sideways, because I didn't do options at that point. Now the beauty is with options and how we're going to train you through the paycheck curriculum, we're going to be able to do it bullish, bearish, or neutral. Well, guess what? Today is the bullish and bearish part of it. Module 3 next week will be the neutral. And again, the reason why you need this is because the market just doesn't go up. You know, for the last 2 years, it seems, we've been doing nothing but bullish trades. We had this little market sell-off or this minor correction. We're getting possibly bearish. We haven't started doing it yet because the market really hasn't, you know, really come in and confirmed it yet. But, you know, we have to have systems in place for bullish or bearish. So the outcome of today's module, you're going to know how to combine calls and combine puts to create income trades that have, based on the statistics we use, a 70% or better success rate. And I hope that you kind of know where that comes now. Remember from Module 1, selling options with 30% probability? That's how we can say they have a 70% projected success rate. You're going to know what is the right trade to use when the market's going up and the stocks are going up with it, and what to use when the market's going down and stocks are going down with it. And you're also going to have the core principles of setting these trades up so you limit your risk and you can hopefully eliminate some of that emotional trading. You know, when I always say eliminate emotional trading, you're not going to be able to eliminate all emotion from trading. You know, I had one of our clients talk to me about that. It's like, Ron, you know, do you get emotional when you trade? I get emotional. The hair on the back of my neck still stands up when I place a trade, but I don't place trades based on emotion. I get emotional, but it's not an emotional decision, if you will. Okay, that's what it's really all about. So today's plan, we'll do a quick Module 1 review just to recapture what we talked about in Module 1. You know, we'll talk about selling options, the good and the bad, kind of things like that. We're going to introduce 5 new key principles of safe option selling. And remember, from Module 1, you know which options to sell now. Now we're going to start adding things to it to make it safer. We'll wrap it up with a big mistake to avoid. And just like in Module 1, I have an action item for you to take. Now, real quick, you know, housekeeping thing. This is going to go exactly like Module 1 did. I'm going to focus on the slides. I got Brian, John, and Jim with me today. They're going to be answering questions in the background. And then after the end of the formal session, Brian will come on and kind of do a Q&A session for any of the questions that came in, they flagged and want to share with the class. So let's go ahead and get started and do our Module 1 quick review. In Module 1, we learned the following concepts. Option sellers have obligations. And at the end of the day, if you sell an option, you are obligated to do something with stock, okay? If I sell a call, I am obligated to sell stock at a certain price, okay? So if I sell a $100 call, I am obligated to that option buyer to sell him stock at $100 a share. Now, Everything that we do from here on out is here to help you avoid that obligation. I never want you to have to handle a stock transaction. If you sell a put, you are going to be taking on the obligation to buy a stock at a certain price. You ever hear the concept of getting a stock? If I sell a put at 90, I have the obligation to buy the stock from my option buyer at $90 a share. At the end, I get put to the stock and I buy that stock off him. If my call expires in the money and I'm assigned, you'll notice in your trading account you will have a net short position. I'll be short 100 shares of XYZ or short 1,000 shares of whatever stock. Now again, I want you to understand what your obligations are. But I've said this before and I talked about it in Module 1. I have not been assigned and have never had to fulfill my obligation on one of these paycheck trades, ever. And it's not because every trade I make is a winner. No. I take losers, okay? But I use prudent management techniques that will help you avoid any obligation. But as a prudent option seller, I do want you to understand what the obligation is. Now, what's the first thing that we're going to do to avoid having the obligation of doing a stock transaction? Well, we're going to sell options that are out of the money. Remember, we talked about we're going to do trades that have at least a 70% chance of success. That means, that the options we sell are going to have a 70% chance of not finishing in the money. Options that are in the money have the most risk of being fulfilled. Okay, we are going to avoid that by never having options that are in the money. So to do that, we focus on that probability of less than 30%. That gives us only a 30% chance of that option finishing in the money, which is the bad part. That's the danger. All right. Now, one thing I also do want to remind you or kind of let you know, and we're going to keep talking about this throughout the course, don't worry. Even if you sell an option and it goes in the money, don't have this irrational fear that I sold a call at $100 and the stock ticked to $100.02. Oh my gosh, I'm gonna get assigned stock. I don't know what to do. I don't know what to do. You're still not gonna get a stock. The only risk of stock assignment is when the option is basically at the expiration date and it's in the money. And there's also some other things that we'll talk about too as we go through the course that could also up your chances of assignment if the option is in the money. I just don't want you guys to think that as soon as that option goes in the money, bang, it's going to get assigned, because it doesn't. I trade in the money options a ton as an option seller for some other strategy that I do that are a lot more real-time trading and active, and I still haven't been assigned stock. So don't have an irrational fear of being assigned. Another thing that we're going to do for Module 1, we talked about setting our expiration 21 to 45 days away. The reason why we set it 21 to 45 days away is a couple reasons. Number one, the premiums are higher at 21 to 45 days. When you start selling options that are 2, 3, 4 days away, there's no premium there and it's too risky. So we want to use a little bit of time to get the premiums higher. We also want to use a little bit more time to give us a chance to mitigate the trade, which we'll start talking about in Module 6. If it goes against us, it gives us time to heal the trade, if you will. Okay? And then last but not least, we're going to sell overpriced options. All right? So you guys remember kind of your mission statement. I talked about that in the mastery session. Our job is to sell overpriced options that are less than 30% probability, or we also can use delta less than 20, that are 21 to 45 days away. That's how we're going to set up our initial option sell. Okay? So that's a quick summary of Module 1. Now, the goal, of course, this happens to be a graph of Home Depot. I have traded Home Depot so many times it's probably not even funny. In a bullish market, we want to sell a low probability put. Okay? So when the market's going up or the stocks are going up, we want to sell puts. Stocks going down, markets going down, we sell calls. So the 132 happens really to meet all of our requirements. So before I even show you the option chain, okay, what are the requirements? 21 to 45 days. Overpriced options, we have. Let me put on my little cursor. Overpriced options, which we have. Another thing that I happen to like about the 132 strike price, it's also beneath the support level of Home Depot when this chart was taken. You know, the market's trending up. We had a little bit of a decline in price, and then the market re-rallied. I like the fact that it's underneath that price. So I also use the graph of the stock to kind of go through some of the strike prices that I can sell that meet the requirements, and maybe I'll fine tune it a little bit. But here's the option chain for that. The 132 put, it was 31 days to expiration. The prob ITM was about 26.8%. I mean, that's basically how we go through the process. It's out of the money because the stock price is greater than the strike price, okay? It's overpriced, and it has a prob ITM less than 30%, okay? Now, in a bearish market, just to review, we want to also sell low probability options. In a bearish market, we sell calls. In this case, the 150 call also meets the requirements. It's got the strike price that's less than the strike price, or the stock price is less than the strike price, pardon me. It's a lot of S's, sometimes I strip over those. The prob ITM is right at 30%, so I can deal with that, okay? And it's also overpriced options. So that's the process in which we go through. So let's talk about selling options. There's some good side of the options selling, and there's some bad side. So let's put this together, okay? Remember, the good side is it's a high probability trade. The bad side is if you sell a put at 132, you take on the obligation to buy the stock at 132. You know, a lot of people that trade very, very high dollar amounts, they like to do this for a living. They'll just sell cash secured puts, and who cares? If the stock goes to 132, they buy the stock at a discount. We're not going to do that. Okay? We're not taking on the stock. We never want to actually own any stock or be short any stock in this concept. That's the beauty of this. We're not going to put that much money into this. If you sell a put at 132, you take on the obligation to buy the stock at 132. As long as the stock stays above 132, you're good. You keep all the premium. You got about a $3 buffer from where the stock is to where your short put price. If it drops below 132, now this is the key. At expiration, you will have an obligation to buy the stock at 132. And again, please don't have an irrational fear of, I bought the or sold the 132 put, we're 2 weeks away from expiration, we dropped through 132, now we're at 131, uh-oh, I'm going to get assigned. The biggest assignment risk is at expiration because options still have time value in the last couple of weeks, so your real risk of being assigned stock is really not till the day of expiration. And a fast forward preview. By the way, if the option goes in the money, your job as a good trade manager is to exit the trade if the option goes in the money. That's your stop price for the trade. We'll talk more about that a little bit later, okay? We don't want to have it if it's in the money. All right, so this is now ServiceNow Corporation. If you sell a call at 70, you take on the obligation to sell the stock at 70. Well, what happens if you don't actually own the stock? Well, guess what? You got to go out and buy it and sell it. So in your trading account, if you're short a call and you don't actually own the stock, you're going to have a net short position in your account because you sold somebody the stock at $70 because that was your obligation. Now, the stock is at $63. As long as we stay below 70 bucks, good. You keep all the premium. If the stock price rises above 70 at expiration, that is where you have the chance to be assigned. You will have to short the stock or sell the stock to your option buyer. Okay? That's how it works. So if you don't already have the stock, you have to go out and buy it at the current price and then sell it at 70 bucks. Well, here's the thing. We don't ever want to have that happen. So let's start putting some things in place. Number one, to prevent that from occurring. And number two, we don't want to be selling naked options anyway. So I'm going to introduce 5 key principles of safe option selling. Let's dive a little bit deeper into this. And the first one, this is the big one. we are going to use rights to control obligations, okay? In other words, you're going to buy an option to protect yourself from the obligations you've taken on from the option that you sold. Remember, when you buy an option, you have rights. If I buy the call, I have the right to have my option seller sell me the stock at that certain price. Okay? If I sell a put, I have the right to sell a stock to my option seller at a certain price, or option buyer at a certain price. What we're going to do, we are going to use the rights of an option buyer to control that obligation. So let me kind of explain this for you a little bit more in detail. If you're bullish, okay, let's go back to Home Depot. Remember we talked about selling the 132 put. If I sell that 132 put, it's going to generate $185 in revenue based on the last price. The last price is $1.85. Remember, an option controls 100 shares of stock. So if I sell a 132 strike price at $1.85, it's $1.85 times 100 shares. I would bring in $185 in premium. Okay, that's going to get credited to my account. Now the problem with doing that is selling the 132 put on its own leaves you exposed to a max loss of over $13,000. And if you sell a call, that's even infinite. So by selling that put naked, if the stock goes to zero, I could lose $13,000 on that trade. So there's a little bit of, there's a solution here. Instead of selling it naked, we're going to buy insurance. If I sell a put, I'm going to buy a put to limit my loss and use the option buyer's rights as a hedge of my obligation. Here's how it works. I'm going to use the original credit of $185 and I am going to purchase an insurance policy on my trade. Okay? I'm going to purchase a put beneath the price that I sold. In this case, I can use the 128 put and I can limit my maximum loss. Okay? A couple of you guys had asked on Facebook about margin and, you know, do we have to buy stocks? No, we are never going to be doing anything with the actual stock price here. We are going to be using another option to control our risk. So in this case, we're going to be selling the 132 and we're going to be buying the 128. This puts a limit on my max loss. Now, what you've just done, and by the way, we're going to be doing this simultaneously, all right? There was a couple other questions I saw on Facebook that had kind of a preview to this. When we do this transaction, we are doing it simultaneously. We are selling the 132, we're buying the 128 in the same transaction. So you're never going to have a point where I sold the 132, but I didn't get my 128. That's never going to happen. It's going to be one transaction. It's going to be done at the same time. You have now entered into what's called a bull put spread. The cool thing about the bull put spread is it's basically named what you're doing. Well, number one, it's bullish. You're going to be doing this in a bullish market. That's why it's called a bull spread. Puts, you're doing it with puts. So a bullish trade with puts, and a spread just means two or more options. You sold the 132 put and purchase the 128 put as protection if the stock makes a dramatic drop in price. Okay, so that's the concept behind this. Now I'll explain the risks and all that stuff here in just a second. If you are bearish, we're going to do basically the opposite with calls. So here's what we're going to do. On Buffalo Wild Wings, if I sell this call, it's going to generate $460 in revenue based on the last price. Remember, the price of the option is $4.60. You're controlling 100 shares, so 460 times 100, you're getting $460. Okay? Now the problem, selling the 150 call on its own leaves you exposed to an infinite max loss. There's technically, theoretically, the stock can go up in price forever. That's why the max risk, it says INF, it means infinite. So we want to cap our risk on this trade. So the solution, same thing as the put, we're going to buy insurance. Remember, when we sold that 150 strike, we're bringing in $460. We're going to use that $460 and we're going to purchase a 160 call to limit our max loss. Okay? What did that cost us? Well, it cost us $170. We sold an option for $460. We used $170 of that to buy our insurance, and we just keep the leftover. This is called a bear call spread. And the cool part about this is, guess what? It's kind of named what it is. You don't do a bear call spread in a bullish market. It basically says what you need to do. In a bearish market, you do the call spread. Okay? You sold the 150 call and you purchase the 160 call as protection if the market makes a dramatic increase in price. All right? So that's the setup of the concept. All right? Now let's talk a little bit more about knowing the numbers. What is the math behind these trades? What's the thing like the risk and the profit potential and all that kind of stuff? There's 3 numbers to know. You need to know what your max profit is. You need to know what your max risk is. And I kind of like to know what the break-even point is of the trade. It's not that important, but I at least like to see what price I got to stay at. All right? Let's talk about max profit. This is how it's done. This is the math behind it. Now, when we get into the assignment portion, we start looking at things like risk graphs and Options Pro, which is what you're going to be using to do this. All this math is already done for you, but I do like you guys to understand where the numbers come from. This is that Home Depot trade, okay? By selling the 132, generated $185 in credit. Why $185? Because that option was priced at $1.85. So when we sell one of those options, we get $185 for it. We're writing the option, and the guy that buys it pays us for it. We're selling it to him. All right? Now, we're going to use that credit to buy the 105 as protection. Now the 128. We're going to buy the 128 put as protection. It's going to cost us $105. Now, we're left with $80 per contract. Okay? See how that works? I sold an option for 132 at 185. I bought an option as protection for 105. I still have $80 of that credit left over. This, by the way, is the maximum profit that I can make on this trade. That's it. All I can make now is $80. If both of these options expire, is the ultimate goal if you're holding till expiration. If the option that I sold for 185 expires worthless, I make $185 on that option. If the option that I bought for 105 expires worthless, I lost 105. I made a net total of $80 on that trade. That's the maximum profit. It's simply what you brought in from the option sell minus what you paid for the insurance. That's what's called the net credit. Okay? That's how the max profit works. Now, the max risk. The max risk on this trade is figured like this. Calculated by looking at the difference between the strikes. All right? Here's how this looks. I have a difference, or what's called a width, of $4. How do I have a width of the trade of $4? I sold the 132. I bought the 128. There's $4 difference between those strikes. That means that my maximum risk is based on the $4 difference between the strikes. Okay? All right? So this means there's a $400 risk on this trade because I have a $4 width of the spread. If I had a $10 width, I would have a $1,000 risk. If I had a $1 width, I would have a $100 risk. Okay? Now, to do the max risk properly, you subtract the $80 credit that you received, and now you have a maximum risk of $320. Okay? 4 times 100 shares, remember it's a $4 width, that's $400, and then I subtract the $80 that I have, the credit, Remember, if I go back, where'd that 80 come from? Comes from right here. I sold the 132 put for 185. I bought the 128 for 105. I'm left with a net credit of 80. All I do is I take that $4 strike price, with $400 for real shares. Remember, it's by 100 shares. I subtract the 80. $320 is my maximum risk on this trade. Okay, that is my maximum risk. Now, the break-even point. By selling the 132 put, your obligations kick in at 132. But since you took in 80 cents a share, remember, $80 in credit, 80 cents a share, you have a little bit of a cushion. The true break-even of this trade is 131.20. So as long as the market, or the stock in this case, stays above the price of 131.20, you will be break-even. You will not lose money on this trade as long as the stock stays above 131.20. That is your break-even price. It's simply the price of the short put minus the credit that you received, which is 80 cents. Remember, we sold the 132, we bought the 128, we have a net 80 cent over. So you subtract that from the short put price, 131.20 is your break-even. Okay, so to make this easier, we simply can just use a risk graph, and the risk graph does the math for you. You don't have to worry about this. Over on the left-hand side of Options Pro, there's a little button that says Risk. If you open up the risk graph and we set this trade up, we're going to buy the 128 put and we're going to sell the 132. We have an 80 cent credit, just like we talked about. Our credit is $80. Our max risk is $320. So everything is calculated for you right off the top there. Okay? Everything is calculated right off the top. Now, if you're looking at this and saying, well, Ron, am I really going to take a trade to make 80 bucks and risk 320? Yeah, you really are. This actual trade right here, it does have a pretty good risk to reward ratio, by the way. You're going to learn more about this in Module 6, but this trade actually breaks down pretty decent, okay? So remember, and I know you look at this, and one of the things that you got to start learning as an option seller, when you trade for probability, you are going to be risking more than your potential profit, okay? Remember, this trade has a 75% chance of success. 75%, okay? Where's that based off of? Well, we're selling a 132 put that has a prob ITM of about 26.5%, okay? That means that this trade has basically a, well, if you want to be precise, what is that, 73.5%, okay? It's got a 73.5% chance of making money on this trade. Now, we'll get more into this in Module 6 as well, but your true max risk on this trade is not $320 either. We're going to be getting out of the trade before it hits max risk, so don't worry about that as well. All right? So let me kind of give you a little bit of a quick primer on how a risk graph works. Now, understand that I've got a ton of videos out there. It's in the assignment video walkthrough for Module 2, and we also in the video section on Digital Chalk, we also have some videos about how to use the risk graph. But there's a couple things I want to illustrate on what the risk graph represents, because I know if you're not used to using options and seeing this kind of stuff, it may be confusing. If you look at this solid blue line, you see how the solid blue line goes down here? It starts eking up, and then it goes all the way up here. The solid blue line represents the profits on the trade at expiration. In this case, it's May 20th, okay? So basically, if you take, see this dashed white line that's running up right here? That's the current price of the stock. If the stock on May 20th is at 135.44, all you do is you line that up and you would have a max profit on that date. Now, what happens if the stock drops to 130? Well, you see the prices on the bottom of the risk graph? This is your stock price. If the stock price drops to 130 on the day of expiration, I would just move up and I'd go to that blue line and I would see that I'd probably lose about $110 on this trade. and all you really have to do is just kind of, I'm moving my little red cursor. See how I'm moving it over to the right where it's it's a little bit under $100. I would lose $110. That blue line intersects with the stock price at the bottom, and it tells you what your profit will be on the day of expiration. Now, in the risk graph, and I have it kind of turned off right now, but you'll also see a dashed blue line. Now, what this dashed line represents, this represents the profit or loss on a specific date. What date does it represent? I want you to look in the lower left-hand corner of your risk graph. You see how there's a little check mark down here in that little dashed line? What this basically says is on April 20th, that's roughly 30 days to expiration, which that happens to be also the day I took the picture of this graph on. On April 20th, 30 days from expiration, so that's basically the day of the trade. That dashed line represents the profits or losses. So, for instance, if the stock was to drop to 132.50 in the next couple hours of trading, at 132.50, I just go up, and that dashed line represents what I would lose on that trade. I would be down probably around $75 on the trade. How am I getting to 75? Well, just look over to the right. And by the way, in the real program, there's a crosshair that you can use for this, so you don't have to like line this stuff up. I would go over here, and that would be about 75 bucks. All right. What if the stock rallies to 140 today? Well, the stock's at 135.44. If you just follow that dashed line up to 140, you would have about, I guess, a $35 profit on this trade where that dashed line is. And again, I would just line my crosshair up with that dashed line. Over here, you'd see about a $35 profit. Okay, so that's really what that dashed line represents. So in this case, we're seeing the P&L for April 20th. All right, remember, it's a little check mark down there on April 20th. If I wanted to see what the stock does if it rises to 140, if it rises to 140, I would just follow that up, and that would be my projected profits. Okay, now on expiration at 140, I would make full profits. But on April 20th, which is the day I took the screen capture, I would only be up about $25 in profits. Okay, so it's showing you two price points. What would happen on the day the trade expires, and then what would happen on the day you took the trade, okay, or the current day of the trade. All right, so let's talk about a call trade. Call trades are figured really the exact same way. This is that Buffalo Wild Wings example. By selling the 150 call, we generate $460 in credit. Because why? Well, guess what? We sold the 150 call for $4.60. We buy the 160 call at $1.70, okay, or $170. We are left with a credit of $290. All right, this is now the max profit of the trade. The credit that I took in minus the call that I bought, I'm left with 290 bucks. Now, as far as the risk is identical. The risk on the trade is calculated by looking at the difference between the strikes. We sold the 150 and we bought the 160. In this case, there's a $10 difference in strike prices. So this is called the width of the trade. This is a $10 width spread. I sold the 150. I bought my insurance $10 away. Width is $10. Because it's based on 100 shares, I'm risking $10 per share. That means there is a $1,000 risk on this position, okay? But we subtract the credit that we received, and now we have a max risk of 710. Because no matter what happens, we keep that credit, okay? That's why we subtract it from the risk. The max risk on this trade would be $710, all right? Now, the break-even point, by selling your 150 call, your obligations kick in at $1.50 or $150. But since we took in $290 a share, we have a little bit of a cushion. At expiration, we wouldn't start losing money on the trade unless the stock is above $150, $290. So we have a little bit more buffer above that 150 call price, and that's just what the credit is. Okay. break even's not a terribly important number going forward for the paycheck principle, but it is a number that's on the risk graph, and I want you to understand where it's from. Okay? This is the risk graph for Buffalo Wild Wings. Same concept, but I have the trade kind of already in place. I want you to notice one other thing on this. Do you see how over on the right there's a little blue area that says 22.50? What this risk graph does, if you enter in the price that you were paid and spent for the insurance, it tracks profits in real time. So you can see based on that, we right now would have a $22.50 profit in this trade. Okay? Why would it be a $22.50 profit? Well, you got to think of it this way. I sold the spread for $2.90. Okay? What's going to happen? How does the spread work? How do we make money in this trade? We sold it for $2.90. My objective is to buy this spread back at some point in time for a lower price. If I sold for $2.90, I want to buy this spread back at some point in the future. So if the price drops from $2.90 to, let's say, $2.80, I made 10 cents on the trade. 10 cents is the equivalent of $10. Okay? Now, if the price drops to $1.90, I sold the spread for $2.90. The price of the spread drops to $1.90. I just made $1 on the spread, or that's $100. And what would I do? If I want to get out of the spread, I simply buy the spread back for $1.90. That's how I profit. Now, the underlying mechanics of this, okay, think about it this way. If I sell a call at $150 and I sold that for $4.60, I sold a 150 call. If the price of the stock goes up, right now it's 143. If the price of the stock rises, what's going to happen to the price of the long call or the short call? It's also going to increase. That's the enemy. Okay? If the price of that short call increases because the stock goes up, I start losing money on the trade. What I sold for $4.60 may now be worth $5. The spread that I sold for $2.90 might go up to $3.10 because the stock's going in the wrong direction. Well, if now the spread's $3.10, I just lost 20 cents or $20 on the trade. Because remember, I have a position on, okay? When I sell this thing for $2.90, it's a trade. The trade is on. I have the obligation to sell stock at $150. I have the right to buy the stock for $160. Just because I take a credit in doesn't mean that the trade goes away. I have this position on. I have the obligation till May 20th to sell the stock at $150. That doesn't just magically disappear. The only way I can rid myself of that obligation is at some point to buy the trade back. And we're doing this both options at the same time. We're getting into and out of the trades simultaneously. We're going to sell the 160 or sell the 150 and buy the 160 simultaneously. And then to exit the trade, we're going to buy back the 150 and we're going to sell our 160 simultaneously. That's how these trades profit and loss. Now, I want you to think about it the other way. What happens? Buffalo Wild Wings is at 143. What happens if the stock drops to $140 a share? Well, what happens as a call gets further and further out of the money? Do you ever have an option that expired worthless because you didn't pick the right direction? Well, what's going to happen is if the stock goes down in price, you sold that call for $460, okay? If the stock goes down, that call that you sold for $460 is still trading. It's going to go down in price too. It might go down to maybe $4. You just made 60 cents because the stock went in your direction. But the call that you bought maybe for $1.70, that's also going to lose a little bit of of value too. All right. So maybe you made 60 cents on this because the stock went down, but this one right here may go down to $1.50. All right. Because as that gets further and further away from being in the money, both of these options will lose value. This one loses value a lot slower than this one. Okay. So you make 60 cents on this one, you may lose 20 cents on the long call. But at the end, if they both expire worthless, this goes from 460 to 0, you make 460. This one goes $1.70 to 0, you lose $1.80, left that $2.90 credit, and you keep that in your pocket when the option expires. Okay? That's the mechanics of how these trades work. All right? That's what happens. And then you just kind of reverse the logic for puts. All right? That's the concept. Now, I want you to understand also your assignments. So you need to know your assignment. I want you to understand what could happen at expiration. Now, I want you to think about this like in baseball, right? When you look at baseball, baseball has kind of a harmony that goes on with it, right? When a ball gets hit to first base, the first baseman goes to first, the second baseman covers second, the pitcher does something. When a ball gets hit to the left side of the field, maybe the second baseman goes to it, the shortstop covers second. You know, if the ball gets hit towards the first baseman has to go get it, but the pitcher has to cover first base. There's all kinds of assignments that happen in baseball. What I want you to understand is what your assignments, what your obligations are at expiration. Now, quick disclaimer. I also, just to tell you, I have really maybe only once or twice ever taken one of my paycheck trades to expiration. I don't usually keep these trades on till expiration. I am either already at profits or I've already taken a loss on the position. I very, very rarely, less than 0.5%, I would say, have ever taken a trade all the way to expiration. All right? But I want you to understand what happens here, okay? Kind of fulfilling what we just talked about on that slide of whatever it was, Buffalo Wild Wings, all right? This is that Home Depot bull put trade. The goal is for the stock to finish out of the money. If the stock at expiration is anywhere above the 132 put, you pay the full credit. All right? Now, if the stock at expiration is between the strikes, all right? If at expiration I sold the 132 and bought the 128, what happens on the day of expiration if the stock finishes at 130? You run the risk of having to fulfill your obligations. Your insurance policy hasn't kicked in. You have the right to buy the stock at 128, but we're not below 128. You run the risk of being put to the stock if you finish between the strikes. All right? I want you to understand that. Now, again, if you manage the trades prudently, if you do the system properly, it's not going to happen. Now, if you let the trade just completely go against you, if at expiration on a bull put trade we're below the long put price, you have an insurance policy. You're protected. Yeah, I have to sell it at 132, but I have the right to buy it at 128. What ends up happening is there's something called the Options Clearing Commission. They'll take a look at your position, knowing that you have an offsetting trade, and they'll basically just cancel your trade. What'll happen is you'll take the full loss. Okay? So remember when I told you that, the max risk was $320? You would take that max risk. You would take that loss. All right? You don't ever want to be in that position, by the way. If you are ever in that position at expiration, I'm going to be blunt. You manage the trade wrong. Bottom line. Bottom line. Okay? If you ever have that happen, you manage the trade wrong. Simple as that. Now, you might say, well, Ron, how the hell do I manage it? We'll get there. We're not quite to that level yet. This is just trade setup. Now, on the call side, the goal for this, remember, this is a bearish trade. If I sell the 150, it's because I expect the market to continue going lower and it's going to expire somewhere out here. If it expires somewhere out here at 140, 135, 145, whatever, I receive the full credit. Both of my options will expire with no value and I will keep the credit. If at expiration the market rallies and we're between the 150 and 160 call, you run the risk of having to fulfill your obligations, right? You have the obligation to sell the stock at 150. You have the right to buy it at 160. If the stock's at 155, that's out of the money. You're not going to have protection. The insurance policy protects you if the stock goes above 160, okay? If the stock goes above 160, that's where your insurance policy will protect you. Now, here's the kicker. Remember I showed you that max loss or that max risk. Guess what? If you let the stock or if you let the trade expire up here at 170, you're going to take it. And again, I can't stress this incorrect. Online. I have never, ever taken a max loss on one of these trades. And it's not because I'm such a fantastic trader. It's because I know how to get out of the trades when they go against me. You do not want that to happen to you. Okay? Now, let's talk about buying insurance. How do you buy the right insurance? You know, I threw some numbers out there. We're going to sell the 132. We're going to buy the 128. We're selling the 150. We're buying the 160. You need to know what strike price to select as your insurance. Now, understand that this also is kind of a building block. By the time we get to Module 6 and we go through Module 5, you're going to know based on things like risk to reward, things like open interest. Buying the right insurance at that point will really become a no-brainer because you're going to start looking at the credits you receive versus the risk. You'll start looking at open interest. It's really not difficult once you have the full picture in mind. When you buy insurance, I want you to think about this as like car insurance, right? I have a $500 deductible in my car insurance. It's pretty low, but I also know that if I back over a mailbox and do $800 worth of damage to my car, I'm going to come out ahead. Now, I pay a little more premium for that very, very small deductible. I could kick my car insurance up to a $2,000 deductible, but if I back over a mailbox and run into my light pole and do $1,500 worth of damage to my car, I have to pay for it out of pocket because I haven't gotten into my $2,000 deductible yet. Now that $2,000 deductible is cheap. I don't have to pay as much premium for it, but I don't have a lot of protection. Being an options trader and putting these spreads together is really right around the same principle of this. So let's dive into this. This is Home Depot. Remember, we're going to sell the 132 put, okay? We originally were going to do the 128, but instead of buying the 128 as protection, let's use a little bit lower price. Instead of doing a 132 put, let's widen that spread. When you widen the spread or you have that bigger insurance deductible, you're essentially taking on more risk, right? Remember, if you go back to what we talked about earlier, the risk of the trade is the width of the spread minus the credit. So if I have a $1 width, that's $100 in risk. If I have a $5 width, that's a $500 risk. If I have a $10 width, that is a $1,000 risk. Now, there is a pro side to this too. Remember, if I start buying options that are farther and farther out, they're going to be cheaper. So by widening the spread, I keep more of my credit. All right? I keep more of my credit. So instead of maybe getting an 80-cent credit for the trade, because I'm only using a smaller portion to buy the insurance, I might have a $1.20 or $120 credit. Okay? Wider spread is more risk, but more credit. All right? Now, think of it the other way. Instead of buying the 128, maybe I make that spread or that width more narrow. If I do a tighter spread, I have less risk in the trade. All right, less risk, because I only now have maybe a $2 width. A $2 width is a $200 risk versus a $4 width, which is a $400 risk. I have less risk in the trade. But I also receive less credit because that 130 put that I buy costs me more money, okay? Now, I know there's a little bit of a suspension here because I haven't got the full concept down. As you go through, and really it kind of hits in Module 6 and a little bit in Module 5, you're going to know which options to choose for this based on the credit and the risk. We're looking for a certain risk to reward ratio. So when you get the full picture of these trades, and as we keep building on the system, this, you know, you're probably scratching your head saying, well, Ron, how do I know which width to use? How do I know which one to choose? Once we get the full picture in, you'll understand. It's going to be a very, very easy process, okay? One of the things that I do want you to start looking at is I want you to start looking at volume and open interest. Now, to be honest with you, you can look at the volume a little bit. I honestly don't care too darn much about volume, but I really like to look for open interest. Open interest is a measure of liquidity. It basically means how many options have been written on that particular strike. So if I look at the 126 strike, it's got an open interest of 1. This one has an open interest of 86. This one's 126. This 130 has 3,773 options, okay? Open interest is a measure of liquidity. And I'll just go ahead and throw this to you guys right now. As we do these trades, we are only doing them on options that have over 100 open interest. All right, there's one of your pro tips, and it's not even looked at. So if you're looking through this thing, I can cancel this option out. I wouldn't trade it. I wouldn't trade this option. I wouldn't trade this option. I wouldn't trade this one. I'm not going to trade this one, or this one. If I was looking to do a put spread on Home Depot, I would be looking at the 125, the 128, the 130, and the 133. Now the 133 I can take off the table because it doesn't have a prob item than 3%. The 130 does, and the 129 is good. You know, these are the ones that I could probably put together possibly for a trade. Maybe the 129 and the, I'm sorry, I got that wrong. Maybe the 130 and the 128. Maybe the, well, that's basically it. The 130 and the 125. But as a rule, we only do these trades when open interest is greater than 100. Do not worry about volume. It's not important. Open interest is the most important number here. So you can take into account volume if you want, but to me, and my experience, open interest is the key. We only do this with options that have an open interest greater than 100, okay? Now, another thing that you guys can do, you can compare spreads on the risk graph, and I talk about this in one of the walkthrough videos. If you want to just model spreads, you know, for instance, there's a compare spreads button up here on the top. For instance, this is a 128, 132. That's that $4 width. I have an 80-cent spread at $4, and I'm comparing it down here at the bottom to the $2 width, which is 45 cents, okay? Not a whole heck of a lot of difference in the risk to reward ratio. They're pretty much about the same, but you know, you can compare if you want to compare and contrast, wider width, narrower width. Now, when we get into module 4 or module 6, pardon me, what we're going to ultimately look at, what we're going to kind of give you is we're going to be looking for a minimum credit per every dollar in width, and we put that together in module 6 for you. Okay, so like I said, as you get more and more into the class, it's going to be a lot easier to understand where you have to choose. But for right now, open interest being over 100 is the key. Okay, so in this example, just comparing two spreads. The pink spread is the $2 width. The blue line is the $4 width. All right. Now, I'm going to bring into the picture your first idea of money management. All right. Profits on this, if you have ever heard the expression less is more, okay, less is more. There's an old saying, half a loaf is better than none. All right. If you're starving and somebody says, here, have this piece of bread, are you going to throw it on the floor and say, no, I want the full loaf, or you can just take your darn bread? Of course not. You're going to take what they give you. All right. In other words, from the trading, it's better to have some credit than none. And we're going to have a similar mentality with our options trading. Okay. What we're going to do is we are going to take profits on these trades early. We are not going to try to make the entire credit. Right? So profits on these trades are taken at 50% of the credit received. All right. So for example, if I bring in a trade and it's got $100 credit, my profit objective is $50. I am not looking to make the full credit. All right. And I'll explain why a little bit more in Module 6, and I'll also explain a little bit more with some backtesting data in Module 3. We'll discuss the details of this in Module 6, Trade Management. Also, what I will do when we start the Q&A session, I'm going to show you a live trade that I actually have on right now and explain why we take profits at 50%. So I'll show you guys a live trade that I'm in. All right. So I tell you, I like to wrap everything up with a big mistake to avoid. Do not hold your trades until the max loss. I cannot tell you how many trades that I've got clients that send to me and say, you know, Ron, I know that I'm supposed to exit this trade when the stock not good money, but I just kind of held on thinking the stock would rebound. You cannot hold trades until the max loss. It doesn't work. Not with these credit spreads, because remember, your loss is a lot more than your potential gain. Okay? That's the problem. You cannot have one trade that wipes out a ton of winners. That is the biggest mistake of being an option seller. And we're going to kind of delve deeper on this as we go through the curriculum. So today, what did you learn? A spread, nothing more than selling an option and buying one as insurance. A spread is just when you trade two options or more simultaneously. That's all a spread means. We learned how to know the numbers, okay? Max risk. What is our max risk on the trade? What is our max profit? What's our break even? We know what can happen at expiration. We know how to use open interest to help us start selecting the right options and instruments. And now we know the first profit targets. So I do have kind of a new line in your mission statement. Your mission statement now reads this: we are going to sell overpriced options that have a probability less than 30% ITM or delta less than 20 with open interest greater than 100. That's 21 to 45 days to exit. Okay? Now, I've got some assignments for you guys. I want you guys to look at two stocks, COO and AZO. Now, when you look at these, you may not have enough open interest on these trades. Just understand that right off the bat. There may not be enough open interest. Do not actually place trades on COO and AZO, please, okay? I want you to build a trade, build a bull put spread on COO. If it's got over 100 open interest, great, all right? Try to find one that does. AZO for a bear call, exactly. Try to find options that have over 100 open interest. If there's none in there, that's okay too. I don't want you to worry too much about open interest right now when you're starting to construct the spreads. I just want to make sure you understand the basics of putting a spread together. If it's got open interest, use it and make sure it's over 100. If some of these options don't have them, don't worry about it. Okay, at this point, we're not actually placing the trade, so it's not a huge limiter. And then I want you to save that trade in Options Pro, and I want you to monitor it, okay? And by the way, how do you save in Options Pro? There's an assignment video that goes through all the steps of doing this, okay? And I'll show you how to save it as a page, understand the risk graph, etc. So that's the goal of what I want you to do for Module 2. We're going to start using the risk graph in Options Pro. Now, Module 3 is going to be next Tuesday at 4:30, all about getting paid when the market is sideways. This, to me, was beautiful. Remember at the beginning of the class, I told you about how, when I first learned how to trade, we had to learn how to trade to be bullish. Well, the cool part is now with options trading, we can also be profitable when sideways markets come in. And it's important because normally as a trader, when markets are sideways, you just get frustrated. All right. But now when the markets are sideways, I can show you a really good trade to take advantage of that. So we're going to discuss that Tuesday at 4:30. So how to profit from sideways and neutral markets. Also, how to identify a sideways or neutral markets. The first building blocks of trade repair, and how to identify a neutral market. So we will see you all in Module 3 next Tuesday at 4:30. Quick reminder, the recordings are actually available now. We put those out this morning so you can start getting used to Module 2. Our mastery support session will be Friday at 2. Start sending us questions. You guys have been doing a great job sending questions to Option Paycheck at VectorVest. Also, I've been kind of monitoring the Facebook group. And a couple things that I noticed today on the Facebook group, I had to go in there and I basically said on one of the comments was, you guys are exactly right. You're already starting to help answer each other's questions because you know it too. So that's the beauty about Facebook. We can all kind of work together on that. And sometimes you guys will even answer the questions before I do. All right, so let's do this. We'll go ahead and start our recording for our Module 2. And we'll kick it off to the official Q&A session. Now, before I kick off the official Q&A session, I mentioned that I would bring up a live trade. Give me a second. I did this trade yesterday. For some of you that were able to see my live coaching class, you might have saw me do the trade on Lockheed Martin, okay? This is a trade that I placed yesterday on Lockheed Martin. And, the only thing I didn't do is put in my fill prices for this trade. So I guess I'll kind of give you an idea of that too. Let's see here. Let me go back to my orders for this. I got to go into my brokerage account. Hang on one second. I forgot to put the fill prices in. This is what you're going to do, by the way, when you trade a trade. All right. So let's see here. Bear with me. All right, there we go. I had a feeling that was going to happen. Okay, there it is. All right, so I did this trade yesterday. Now, this is the trade that I did, 340 and 335. That's the Lockheed Martin trade that I did yesterday in class. So I'm going to click on Edit Spread. Now, what I'm going to do is I'm going to put the prices that I actually did this trade at. I sold the 340 put for $6.40. And I bought the 335, which was my protection, at $4.90. Now, you can see today, if I look, I sold the put for $4.95. Or I'm sorry, I sold the put for $6.40. Guess what? It's already down to $4.95. Lockheed Martin went up $4 a share today. So that put that I sold is decreasing in value. That's good. If I sold that for $6.40, I made some money. Now, the option that I bought for $4.90 is down to $3.75. So I'm losing a little bit of money on that one. But as soon as I click OK, I'm up $210 on this trade as of right now. And again, I put this trade on yesterday. So let me kind of illustrate what this risk graph is saying. If you look at that little blue box over there, it says 210. That's what I'm up on the trade, okay? That's how much I'm up in this position right now, $210. So I sold this thing for $1.50. If I bought the trade back right now, I would be buying it back for, I don't know, I'd have to actually look. But, I'd be able to make $210 on this trade. I sold it for $1.50. I can buy it back for, whatever it is now. It's probably like 90 cents. All right. Now, see that dashed line? I know the market is closed, but if the market rallied up to, let's say, 356, I would be up about $500 in this trade. Now, let me illustrate a couple of things on this real-time trade. I told you that my target profit is half the credit that I sold for. All right. I sold this trade on 7 contracts for $1,050. My profit target is, my goal is to make $525 on this trade. Okay, that's my profit target. Now, when we get into Module 7, I already actually have an order in for the broker to do this. We'll talk about that in Module 7. Now, the max risk on this trade is $2,400. But let me also show you something while I got a live trade on. I manage this trade by taking it off the table if I make 525, or if this market drops below 340, that's my stop. Now, if I go below $340 a share, this is how much money I would lose on the trade. I'm only going to lose about 500 bucks. That's it. My target is to make $525. My risk is $500. I have a trade that I set up yesterday that has a 70% probability. My max profit in this case is 525. My potential loss is 500 with a 70% probability. That's why I took this trade yesterday, and some of you may have saw it in my Monday class. But this is kind of a live one, that just to give you guys an example of how this works. Okay, that's essentially how it works. Now, a lot of people always ask, Ron, why do you take profits early? I want you to think about it this way. How much does Lockheed Martin have to move up in price for me to make $500? Follow the dashed line. For me to make $500 on this trade, I only have to go up to about $356. You see how my cursor is on that dashed line? Right there's about 525. I only have to move up 350 to 356. The stock only has to go up $6 more for me to make profits. How much more does it have to go up for me to make the full credit? I want you to look at this. Here's 356. It's right about here. This is where I would achieve 50% profits on the trade. In order for me to get all the profits, the stock would have to go up another, what is that, 356 all the way to like 378. This would give me max profits. I would have to go up another $21 a share to get to 100%. 50% is easier. Now, I will show you guys in Module 3 some back testing that illustrates why it's better to take profits at 50% and take profits early, okay? But I wanted to illustrate how that works. All right, Brian, I'm sure I just got hit with a ton of questions on that one, but I did want to show it a little bit more live in a real trade.
No, actually, that was pretty good. We didn't get a lot of questions on that. I think, basically some people were like, oh, that's cool, and they were just asking a couple of questions about, the work. There wasn't a flood. So I think it's a great time to just say, this is covering some of the questions that we got earlier in the session, that this is, think of today as introducing a lot of people to this trade. I know in the class we've got hundreds of people, so we've got, there's people who have never seen a spread before, and some people who are experienced with spreads. So just keep in mind, Modules 1, Module 2, and Module 3, our intent is to just introduce you to the concepts of these trades, build a nice strong foundation, tell you a little bit about how to manage them, just kind of whet your appetite a little bit right now. But then when we get into Modules 4, Module 5, definitely Module 6, the course builds on itself. I always think of it as adding layers to your knowledge sandwich. So those of you who are experienced, one of the things that we'll ask you to do, like Ron was just mentioning before, you'd be an awesome resource for some people on the Facebook group. Be an help out. Just like we will help you. You can. What's it called? Pay it forward. Pay it forward to some other people on the Facebook group, and then when we get to some of the modules where things are new to you, then you'll be getting help too there. So, are you ready for some questions, Mr. Wheeler?
I certainly am.
All right. So I promised a bunch of people we would get back to them, and I'm just going to go in order, folks, of how the questions came in. This first one is from Carrie. One of the questions is about, there's a thing, and some people might not know this term, the Black-Scholes pricing model. So Carrie says, are models other than the Black-Scholes standard deviation used which factor in an individual stocks and similar stocks' past performance.
I mean, there are other things other than Black-Scholes, but we pretty much just focus on the Black-Scholes concept because that's kind of like the industry standard, if you will. So that's what we use. And, we use that because when we created Options Pro, that really used and really harnessed the best probabilities, the best numbers. That's really the industry standard.
All right, cool. Next one is from, and just so you guys know the order that I'm going to go, I got Todd, Mokhtar, Dennis, Paul, Lou, then Joseph, and then some others after that. So that way you know your order in line here. So this next one is from Todd. He says, wondering if we are buying and selling at the same time, why does it matter if the options are overpriced or not?
Because, and you got to think of it this way, right? I want you to think of an overpriced option. Let's say an option is overpriced by 20%. All right? If you look at this trade on Lockheed Martin, 20% of $6 gives you more premium than 20% of $4. So we still want to have overpriced options. And I know a lot of people say, well, Ron, you're buying one too. Is that a big deal? It is a big deal because we're selling an option closer to the money. So think about it this way. If I sell an option for, let's say, $2 and it's 20% overpriced, I'm going to get 40 more cents premium on that. If I buy an option that's $1 and it's 20% overpriced, it's only going to cost me 20 cents more, I still get a 20-cent premium on that of being overpriced. Now, the reason kind of it goes into the math of the trade is in Module 6. You'll notice that when you take trades on underpriced options, you will not get the minimum credits that you need to place the trade. Remember, we're not just going to take any old trade, okay? You look at this trade, and I showed you that, for instance, I'm looking at about a $500 potential profit and only about a $500 potential loss. That's beautiful. What I want you not to do is take a trade like, I'm just going to put one together real quick, something like, let's say, this, where I have a credit of $400 but a risk of $6,000. I can make $200 if I win, and if I lose at the short strike, I lose $2,300. That's the kind of stuff that happens on underpriced options because the premiums aren't high enough. So, it's okay. I know you're buying an option too, but remember, the one that you sell is a lot more expensive, so you're getting bigger bang for the buck on that option.
Yeah, cool. And then that example that you gave, like of the one that you sell was 40 cents, where you're getting 40 cents for it, more, and the one that you buy is 20 cents. There's that whole concept of what, like regression to the mean. Let's say
Exactly.
Nothing happened with the stock's price, like everything was flat. There's a regression to the mean. So basically, let's say both of those regress back to the mean. Well, basically, you're going to net 20 cents on that deal just because nothing happened and then went back to normal trading.
Right. Exactly. Good question.
Yeah, Ty. Mokhtar, you ready for Ron?
I am.
All right. A few people were wondering about commissions, and it's very understandable because options are kind of new to some people. Mm-hmm. Mokhtar says, would commission costs cut significantly into your net credit? He says, it seems to be the case to me.
If you have a broker that doesn't really have a good commission structure, sure. I mean, you can use something like Tastyworks has really low commissions. E-Trade has low commissions. Heck, even Charles Schwab has low commissions on options. I pay about 50 cents a contract. So, on this particular trade, I get in at 14. I get out with 14 because I'm buying and selling 7 simultaneously. This trade right here is going to cost me $14. So if I make $5.25 and my commission costs are $14, I mean, what is that? 2% of the trade or something like that. My math skills are terrible, but it can. And that's another thing that we'll talk about in Module 6. There's a minimum credit. I won't take a trade if I have to trade more than 25 contracts. That's something we talk about in Module 6. But if your commission costs are, averaging over, $1 a contract, you should probably look to get a different broker because there's a lot better ones out there.
All right. next up, we've got Dennis, it looks like. Now, we won't get into all the management rules, but since you were teaching the concept of the trade here, Dennis is like, man, like on that bull put you showed, if a stock gaps down well below both the short and the long strike, but there's 2 weeks or more until of time remaining, what typically happens with the broker?
Nothing. You'll just have a net loss on the trade. You know, even if the market, let's say something bad happens and Lockheed Martin gaps down to $330 tomorrow, which would be a $20 move, I would lose $1,200. My trade would be down $1,200. Not going to sign on anything because there's still so much time left in the trade. There's 30 days left. You'll just have a big loss. Now, I will tell you this, even with some of the big moves in the market that we've had the last couple of weeks, I still did not really go below any of my short strikes in the few trades that I had on, because that's the beauty. We're placing these trades far outside, you know, the movement of the stock. So if worst case scenario, if the stock gaps down, it goes to 330, oh well, I lost $1,200 in the trade. But I got to tell you, that does not happen very, very often. It's because, you know, the stocks have their average move, and, you know, it's not something that it's one of those things where it's, you know, a handful of times on one hand, you know what I mean? But you would take a loss on the trade, but it's not like you'd get assigned or anything.
All right, next up, we've got Paul. Paul asked this question when you were showing that slide of, you know, the difference between a wider spread and the one where it's more narrow, where the one you sell and the one you buy is close together.
Mm-hmm.
And Paul said, well, to make, let's say, $1,000, you know, is there any real difference between doing like 10 contracts of a narrow spread versus 5 contracts of a wider one? Isn't the risk the same?
Mostly, it's pretty much the same, but sometimes it's not. Sometimes options can be priced a little bit goofy based on things like open interest and liquidity. For the most part, it won't make a difference, but there are some times where if you try to go with a wider spread, your risk reward of the trade, and we'll talk more about that in Module 6, may not be enough. And like I said, when you start getting the full picture of how to choose the right strikes based on your risk reward ratio, it'll start making sense. You know, I can tell you that Lockheed Martin, the 340, 335 trade looked perfect, whereas the 340, 330 trade really wasn't, because you didn't get enough credit to offset that $10 width of the spread. It really will start coming into focus once you have the criteria that you're looking for the minimum risk to reward.
All right, the next group is actually a handful of people asked the same question, and it made me think we should probably put this into the slide. It was when you were talking about open interest. And I was looking on our frequently asked question page. I couldn't find a video on this, Ron.
Okay.
People are saying, do you look for the greater than 100 open interest on both the short and the long legs?
Correct. Yes, over 100 on both options.
All right, cool. So that was Paul's question. That was Lou's question. And I think it was Al's question. So we had a handful of people asking the same question. David, David's asking what open interest is. David, you can actually just Google open interest. But David's like, does open interest mean that someone has put in an order to open a trade?
I'll put a link in the chat window for this from Investopedia. And I guess we can put that probably up somewhere too in the mastery or whatever. But really the only time open interest changes is when an actual trade goes through. When somebody writes a contract or somebody buys one. That's the only time that open interest will change. It doesn't do it based on orders that are placed. The order actually has to be executed. And that's how open interest adjusts. And it can go up or down as options are canceled.
Whereas volume goes up, right?
Right.
You're not going to see volume come down.
Exactly.
All right, Boris. Looks like Boris had to duck out right before I asked his question. Boris said, even with a good open interest, is there a scenario that one cannot get out of a trade if it goes against you He's like, meaning that there's no takers for the trade when I'm trying to sell it, when I'm trying to get out of it.
I've never had the experience of having that happen. I've had it where some customers said, Ron, I got an order in there to get filled, and what I do. There are, and again, this is like one of those less than 5% of the time, probably less than 3% of the time. And I'll talk more about this in Module 7. But you can exit out of the trade step by step. If a trade is going against me, think about it this way, right? If this market opens at 330, what's going to happen to the trade? Well, I'm going to be losing a lot of money on that 340. And that's the option that I focus on first. And I'll just buy back the 340. And then once that trade is out, I'll just sell my 335 at a later time. Or I can just do it right afterwards. You're talking something that would happen 1-2% of the time at most. I can tell you this. I've never had a problem getting filled within a couple of minutes, even when the trade's going against me. Because remember, you're selling an out-of-the-money option. Out-of-the-money options typically have lower open interest. As those options get closer to being in the money, volume and open interest are going to start picking up. So as they get closer to the money, you're going to see those traded more, and it's going to be easy to get out of those positions.
All right, next up, we've got Joseph. Joseph says, do we adjust the open interest higher than 100 if we're buying more than like one spread? Like let's say we're doing 15 contracts or a lot more contracts. Do we have to look for a higher open interest?
No, 100's a base, and that's really all you need. Like I said, it's not a true measure of how many contracts are out there necessarily. It's just a base of liquidity. I mean, you'll notice me, I've got 7 contracts on Lockheed Martin. I may do 15 contracts on the SPX or 20 contracts of something else. I still use 100 as my base.
All right, this next one's from Paul. He uses, I believe he uses Thinkorswim just like you do, Ron. So he says probability of touch, which I guess is something that's in Thinkorswim.
Right.
He says is usually a lot higher than probability of expiration in the money. So is that addressed in one of those videos that you made?
No, because we don't use probability of touch. Okay. Probability of touch is just not a factor that I use. I actually answered that question on Facebook too, and no, it's just not a variable that I use. Probability of touch just means, will it ever touch that strike price during the life of the option? And I honestly don't care about that because it's not something that I've ever needed, in the back testing has shown it doesn't really make a difference for how we do the trades. So it's just not something I take into account.
All right. Interesting question from Ivan. He's like, well, if we're watching our trades, like if we're really on top of things and we don't take the trade to expiration, why not have wider spreads on your insurance?
It comes back to risk to reward ratio. You don't have the full picture of the minimum credits that we're looking for. So it may not work out from a risk reward perspective to have a wider width. Like I said, when all the pieces are in place of this, it's going to be really apparent which strikes that you're going to choose based on open interest ratios.
I'm surprised I haven't seen somebody ask the question, why buy the insurance anyway? So we're not going to answer that one right now, but let's move on to Michael.
Somebody's going to ask that now.
So we're going to, right now, I haven't pre-read these questions, Ron. There's a bunch left in here. I'm going to do my best to read them while you're answering each question. But Michael asks, are the spreads considered one transaction or two? He's like, I've got a $6.95 transaction fee, and how many contracts do I need to purchase to make it worth my while?
They are considered one transaction. So getting in and out of the spread is one transaction.
You stinker. You answered that one so fast I couldn't read the next.
Sorry.
All right. Let's see. Those of you who are interested in, you were looking at the Lockheed Martin trade and you're wondering what triggered Ron to enter trades and everything. For our purposes, we're going to cover our rules and our knock entry rules in Module 4. Keep in mind some of the things that Ron does in his Monday sessions with his, the bigger coaching group. So he will, if something is going exceeding the rules set forth in the paycheck course, he usually lets people know. He says, hey, if you're taking the paycheck course, this is more aggressive than what I teach in the paycheck course. So if that's the benefit of kind of watching those sessions. You can kind of see different ways of doing it, but we're going to teach you in this course in module 4, entry rules. All right, Gordon, as far as calculating maximum risk, Ron, that's module 6, right? We get into that?
Well, you mean like at the short strike, we talk more about that in module 6, but tonight we talked about that. It's just the difference at the width minus the credit.
Okay, yeah. So there's you'll hear Ron have terms of max loss, max risk later on in future modules. So let's see. Those of you, we had a few people say they weren't getting the emails for the Monday sessions. What we would ask you guys to do is just make sure, check your spam, check your junk, because we send an email and GoToWebinar sends you an email. So make sure you check and you whitelist or whatever your email system sets as a safe sender, the email address of customercare@gotowebinar.com. So those emails come from GoToWebinar with your join link in them. Let's see. Lou had a comment which is actually goes along with what you're teaching here and the benefits of doing spreads. He says, in that Lockheed Martin example, it looks like if the stock doesn't even move at all, Ron could reach his maximum profit. It doesn't go below 340 prior to expiration.
Yeah, exactly. And that's where time decay, if the stock doesn't move in your direction, time decay comes in and that option will expire worthless. That's the beauty of being an option seller.
All right, and those of you asking how to enter the orders, we'll cover that in module 7. Like how do you enter the buyback order? How do you enter what to do when you closing it for a loss? All that stuff is covered later on. Mariana, same thing with yours. When you say, do you have a standing order to sell at the 50% point and close at the 50% loss? So just for clarification, Mariana, we have a 50% profit target. Ron didn't say anything about a 50% loss. So Ron mentioned a 50% profit, and yes, there is a standing order for that, but we don't have a standing order for the loss. We'll cover all that later on.
Right. We can do it if you want for a loss, but again, that'll be something in module 7.
All right. Charles says, is there a way to determine overpriced simply by looking at the chart of DT options over under? Is the risk graph not live? So it looks like, Charles, you're asking two separate questions. Is the risk graph not live money and just on the screen?
No, the risk graph is live. I mean, that as the trade progresses through the day, that'll jump up and down, and it gives you real-time options pricing and real-time changes.
Philip has a margin question. He just wants to know, does the broker hold you responsible in your account just for the maximum risk on the trade?
Correct. Yeah. For instance, on that Lockheed Martin trade, well, I can tell you what my margin is, but I'm a little bit different. Let me look here. Account statement, options. Oh, my margin on Lockheed Martin is about 500. I use portfolio margin, so it's a little bit different in my account. But if I was just regular, if I didn't have portfolio margin, which is another can of worms, but if I wasn't using that, you can really basically just look at what the difference is between the strike prices. So on this trade right here on Lockheed Martin, since I have a $5 width on 7 contracts, this trade would essentially have a $3,500 margin requirement. Okay, think about it this way, right? It's a $5 width, so that's $500 of risk times I have 7 contracts, so that's $3,500 in margin requirement for this trade.
All right, James had is more like an aha moment, or I don't know what to call it, but he's like, same thing that Lou was just talking about. In cashing out your trade at 50%, you're saying the stock needs to move significantly to capture the other 50%, but really a sideways move for for the exposure to the expiration date will earn you the other 50%. He says, it seems like volatility in the specific stock should be a consideration in timing to get out of the trade. When I first read it, I thought he was having an aha moment on how important volatility is, which is why we're looking at the over and underpriced. But I don't know if you caught all that question there, Ron, about the initial 50% versus waiting for the other 50%.
Right.
Did you want to add anything to that conversation?
Well, I mean, we do take into account, and this is more of a Module 4 thing, I'm not going to trade a stock that is, all over the place. So I do take into account volatility. I only want to trade stocks that are going something like this or something like this. If a stock is going like this all over the place, I'm not trading that stock. So that's when you say, do we take into account volatility? We do. That's just the stock's volatility. That has nothing to do with options. So yeah, I do take that into account. We talk a little bit more about that in Module 4. Now you're right. Ultimately, if the stock goes nowhere, I will eventually, as the trade ticks down, I will get to 15% or 50%. If the stock stays at 50, this trade will be 50% profitable in another 16, 17 days. But then I have to, if I want to get the remaining 50%, I'd have to keep the trade on for 2 more weeks. And then who the hell knows what can happen in 2 weeks? The stock can go to 330. So it takes longer, regardless of time decay, regardless of price, it takes longer to get to full profits than I want to be in the position for. By keeping the trade on longer, you are exposed to more volatility in the market. You're exposed to changes in direction. Our goal is to get in and get out as quick as we can using the stock prices movement and a little bit of time decay as our benefit to get out of this trade as quick as we can. We don't want to be lingering in this thing.
All right, next up, pardon me. Those of you wondering how Ron found Lockheed Martin, we will cover things like that in Module 4 and Module 5. So,
yeah, had a little bit of Module 6 with reward risk.
Yep. Let's see. Howard says, do you usually make these kinds of trades around earnings?
No. We'll talk more about that in Module 4 with trade landmines. You do not do these near earnings at all, ever, because earnings makes a stock move a ton and it's too dangerous. These are trades that we do, and we'll talk about this in 4, at the very, very least 14 days before earnings and be out before the earnings announcement.
All right. Gordon says, do you consider the added cost of short-term capital gains tax and cost per contract when determining your overall trade strategy?
Nope.
Max says, what's an unreasonable commission rate to pay for an option trade?
Probably anything more than like $1 a contract, $1.50 a contract. I mean, if you go to Interactive Brokers, they're ridiculously cheap. I know, Brian, you use Options House or E-Trade now. They're relatively reasonable. Schwab is reasonable. I mean, anything more than $1, $1.50 a contract is probably getting to the point where you'd probably want to start thinking somewhere else, or at least calling them and saying, hey, you people are ridiculous. Fix this.
Yeah, they don't want to lose you as a client. Let's see. Brad says, to sell options, do I need to be able to short stocks with my broker? He says, I have E-Trade and I think I need to get approval to short stocks.
You don't need to short stocks because that's unprotected. You need to have, usually most brokers, and it really just depends on the broker. I know that, TD Ameritrade, I think, is level 2 for this. Some brokers are level 3. You need at least level 2 or level 3 options clearance. Just have to call your broker and ask. Say, listen, I'm going to be doing vertical spreads. What option account do I need?
Yep. So you basically need you do need a margin account.
Correct.
Gary, we're not going to be using the options analyzer in this course or the option pricing model for this course because everything really is either an Options Pro or basically some of the features that we'll use you'll find with a broker. James, I think we answered this earlier. Correct me if I'm wrong, Ron. He says, if you have a significant gap down against you because you have a spread, does the broker only consider the net for the margin requirement?
Well, the margin requirement's fixed. It doesn't matter if I wake up tomorrow and this stock goes to 280. My margin requirement's fixed. I only need to put up 3,500 to take this trade. Now, I might lose all 3,500 of the trade, but or 2,500 in this case, but the margin requirement never changes for the trade. It's always the max at what your difference between the strikes are.
All right, Michael, here it is. Why buy the insurance if you're going to close the position at the short strike anyway?
You have to. I have zero problem with anybody if they just do this trade and they just sell the short contract. Now, here's the downside of this. You're going to have to put up a lot of money to do this trade. Yeah, you're going to have a credit of $4,400. The max risk of the trade's $250,000, and you're going to have to put up, probably maybe $50,000 in capital or $50,000 in margin to put this trade on. That's the downside. So if you want to sell naked options, I really don't have much of an issue with it. If I lose at the short strike, I might make $2,200 on this trade, and if I lose at the short strike, I'm only going to lose like $1,600 or $1,700. You don't have to buy insurance if you don't want to. Really, the reason why I tell you to do it is because you can do this with a much smaller amount of money by buying the insurance. Instead of putting up $50,000 in this position, I can just put up $3,500 and put this trade on and still get a good return on my investment. So if you want to use this principle to do naked option selling, honestly, it's a really good plan to do it.
I'm going to jump down to one that just came in. I know I'm going out of order here a little bit, but they got a little freaked out. Like, wait, you just said a margin account is required. Does that mean you can't do it in your IRA?
No, you can do them in IRAs. And again, IRAs, call your broker. I can do this in my IRA. I know a ton of my clients can do it in their IRAs, but every IRA is different. You might have to get a little bit more option level trading. So a lot of people do this in their IRAs.
John just wanted to know about how long each day does it take to manage and watch these things?
About 3 to 4 hours, I'd say. I'm just messing. Brian, you laughed immediately. No, it really doesn't take much. To manage these trades, you're talking a couple minutes. If it's at a price where you need to exit it, you just have to manage it with a broker. If when we get into Module 6 and you want to choose to take a mitigation route, what I usually do, I was out of town, or I was on vacation, not really vacation, but I was out of the office the first week of February when the whole market seemed to collapse. I managed all of my trades with my Thinkorswim mobile app. I didn't even have to load up Options Pro. I just saw what the prices of the SPX were in some of my stocks, and I managed the trade right from my mobile app. And even when the market took a nosedive like it did, it probably took me no more than 10 minutes to put the adjustments on and manage the position. There's going to be a learning curve at first. Don't get me wrong. It's kind of like riding a bike. You get the little wobbly, but once you get comfortable with the spreadsheets and the checklists that we give you, really, if you check the price of the stock in the morning or in the afternoon, I sold Lockheed Martin a $340 put and the stock's at $350. Okay, nothing to worry about. Oh, it's at $360, nothing to worry about. Maybe my order got filled to take profits. All right, now it's at $342. I better watch it maybe a little bit closer because I may have to exit it. But again, you're not, it's not a difference of if you don't get it right on the money, it's going to be a huge loss versus a smaller loss. It's really at the worst a couple minutes a day just to monitor what the stock prices are doing.
Hey, Ron, could you go back to that slide that had today's key principles on it? The summary slide at the end there?
I can do it, but I probably won't be able to do it fast.
We're going to time you.
This one? Today you learned?
Today you learned, yep.
Okay.
All right. So, there's like 20, 30 more things in the chat box. So what I'm going to do right now is those were the key principles from today. I know a lot of the questions that are coming in now are dealing with things that we're going to cover in future modules. But before you head out tonight, if you have a question on one of these 5 things that you need answered right now, like if you need to know, more information on how a spread really works, what's the deal with, selling and buying one, what's that all about? Do you need a little bit more understanding on knowing the numbers on how, the maximum risk is calculated and basically the numbers? If you need help knowing what your obligations are, even though we're not taking these trades to expiration, we wanted you to understand what the obligations are if expiration did happen. If you have questions about open interest or profit targets, those 5 things. I'm going to open up the chat now only for those questions. Like if you have questions on how to enter an order or market timing or trade management, save that. We want to see if you have a question on one of these 5 things. Okay? So basically, if you're asking a question now, I'm going to look over, and I'm hoping it's on one of these 5 things. All right, so I'm not even going to read this one. I'm just going to go to, I'm trusting you, James. James says, if we look at the recent market activity, do you have an idea what the exposure to loss would be in spread for insurance? The question really is, how important is the insurance if you carefully monitor the market? I think we answered that exact question earlier.
Yeah, I mean, it's still proportional if you get the right credit. That what we talk about a little bit more in Module 6. It's still proportional. So even if you don't buy the insurance, you're not getting a ton more risk by going naked. You're going to get a lot more credit, remember, too. So it's not really a ton more risk. I mean, I can answer that question like this. I mean, if I look at Lockheed Martin, all right, I did this trade to get $1,000 credit. At the short strike, I'm going to lose about $500. Well, let's just say I did the trade naked. I wouldn't sell 7 because that's a lot of credit. I might only sell 2 to get my $1,000 credit. At the short strike, I'm still only losing about $500. So it's proportional if you buy the insurance or if you don't. My profit target's about $640 or so, and my risk of loss is about $600 or so. So it's still pretty much, proportional, naked or not.
All right. Oh, and I love how Tim asked his question. He actually started his question with the topic of his question. He's like, profit targets, and then he asked the question. And that's actually a great thing to point out to everybody. If you're going to ask a question, whether you put it on Facebook or send it to us in an email, give us a little bit of background. Like, what's the topic about? And if you specifically know, a portion of the video that or the module that you watched, like, hey, I have a question about key principle number 2, and it just kind of give us more specifics so we can help you even better. So with that, I'm going to go to Tim, and then I'm going to pop back to Tom and David and so on. Tim says, question on profit targets. Is there a way to see the data from the risk graph in a populated spreadsheet or other form other than following your cross pointer on the risk graph?
No, you don't really do it as following it like this. There's not like you said, like a spreadsheet.
All right. And let's see, Edward, you just typed in a comment. I'm going to go to you, Tom. All right. Well, you might need to put back your Lockheed Martin trade because I thought we could actually use that. Tom says, can you just explain again what happens when you have a price between the sell and the buy at expiration? And Ron's going to talk about it, but just remember, did I say Tom? Ron's going to talk about it. Tom, just remember that we're not going to be holding these till expiration, but Ron, take it away.
What's going to happen? Let's say, I sold the 340 and bought the 335. If I let this trade expire and it expires right at like 338, that's completely between those 2 strikes. What's going to end up happening is you're going to get put to the stock at 340. You're going to wake up on Monday morning owning 700 shares of Lockheed Martin at $340. You're going to lose $4.90 on that put because that put that you bought as protection expires worthless. So you're going to get put to that stock if you expire between the 2 strikes because your insurance doesn't work or doesn't come in until you actually go below the insurance strike. So if I finished at 334, then what's going to happen is my right to buy the stock at 335 is going to cover my 340, or my right to sell the stock at 335, pardon me, is going to cover my obligation to buy it at 340. So the trade just cancels itself out. There's a what's called the options clearing commission, and they will just cancel that trade out.
All right. Now, I did just answer David in the chat box, but he's just like, no protection? What are you talking about? What if you sell a naked call and 20 minutes later the company is being purchased at a record 100% premium? And then he gives another scenario about a put. Maybe
well, you would just lose a lot more money, ultimately. That's the downside of doing it without protection. You know, now I would tell you this, I've never seen that happen before. Even when we're doing this out of the money, I have never really seen, and maybe it's just because I'm choosing the right stocks. You know, one of the things you have to understand to do this, I'm not looking for a stock that's 50 cents that may go to $4. I'm looking for stocks that have good growth, good earnings, good fundamentals. That's why you look at some of the stocks. You know, some of the trades that I've done this year, just to give you guys an idea, all these trades I found through my Monday class. To give you guys an example, I traded Dollar Tree. I've traded VMware, NVIDIA, Dollar General, Walmart, Marriott, Apple, Home Depot, Netflix, Lockheed Martin, Adobe, Facebook, Best Buy, IBB, which is the NASDAQ biotech ETF. I'm not doing this on like really low volume stocks. I'm looking for stocks that have a lot of volume, that don't really have a lot of surprises. You know what I mean? They're not biotech for, and the stock's going to go from 2 to 30. Those are not the stocks that I do this with. They've got to be good, fundamentally strong stocks. Even in a down market, I'm still looking for good fundamental stocks.
All right. Let's see. Jim says, if you already own 1,000 shares of QQQ, would you use this system against it without insurance?
No. I mean, you know, if you own the stock, all you can really do is covered calls. Covered calls are a different animal because the expiration needs to be a little bit different because it's a different perspective. So not this system for that, no.
All right. And folks, keep in mind on Friday, we're going to have our mastery session as we do every Friday. I think a good practice to get into would be when we do the mastery sessions and when we answer things on Facebook and things, preface your question with what key principle you have a question about. If it's about one of the key principles, because those are really the main things we want you to understand. So on Friday, we're going to talk about modules 1 and module 2. And we're going to start off the session. You know, Ron, of course, will go through the key principles and talk about them and go through the homework assignment. But then we're going to open it up to questions about the key principles from module 1 and module 2. So it'll help us out if you can say, hey, I have a question about key principle number 3 from module 1. Okay, so that'd be very helpful. And with that, folks, I think we'll wrap things up for today. And so I'm going to pass it over to you, Mr. Wheeler, to do our final wrap-up.
All right, good deal. And then remember, this is not a criticism or anything, but if you have questions, remember the motto, help us help you. Try not to send an email and saying, you know, I don't understand this, because that doesn't help me try to get you to the right step. Say, hey, Ron, and like Brian just said, hey, Ron, in module 2, you mentioned about wider widths. What about this, or kind of like this? Because we want to make sure that you're ready to implement this and get this going as fast as you can. But like I said, you got to lead us a little bit so we can help you get the information processed fast. All right, I'll go ahead and leave you guys. It's about 6:20 here on the East Coast, so it's a good time to shut her down. Thank you guys. Great questions again. And I know it's hard for some of you based on the questions that you guys are asking. It's one of those things that we're teaching it in increments. So we're going to get to all those things. You know, that's the cool part. You know, when you guys ask some of those questions, Brian never said, ooh, I don't know if that's ever going to be covered. No, it's going to be covered. Every possible element of doing this with money management, everything, it's going to be covered as we continue to step through the program. So I leave no stone unturned. Feel confident that we will put this entire system together over the next remaining 5 weeks. All right. So good night, everybody. I will see you all Friday for the mastery session. I will continue on Facebook as always. I am trying to get questions answered as fast as they come into that options paycheck. Probably won't answer them tonight because I'm going to go home. But I'll be back in the office tomorrow at 9:30 to keep those up. So on behalf of all of us, thanks again. We'll see you guys Friday for the mastery and then next Tuesday for Module 3. Good night, everybody.